Under the impact of the U.S. China trade war, China's economy is rapidly entering a cold cycle. Exports are plummeting, domestic demand remains weak, and inflationary pressures are mounting. In May this year, China's exports to the United States dropped to their lowest level in 5 years. With sluggish internal demand, the Consumer Price Index (CPI) has now risen for 4 consecutive months, behind the appearance of steep discounts like corporate layoffs and shrinking household incomes. As price wars become the norm, people are tightening their wallets more than ever. This is more than just a data fluctuation, it's a profound shift in lifestyle. Amid this silent economic winter, how can ordinary people protect themselves? According to data released by the General Administration of Customs on June 9, China's total exports in May fell 5% short of expectations and dropped 8.1% compared to April. To date, growth has only reached 4.8%, the lowest in 3 months. Imports also saw a year-on-year decline of 3.4%, far exceeding market expectations of a 0.9% drop. This was a 3% deeper contraction compared to the previous month. In contrast, China's trade surplus expanded to $132 billion in May. Economist and analyst Xu Tiancheng noted that while some high tariffs were lifted in May, the damage had already been done. Despite a preliminary agreement between the U.S. and China to pause tariff increases mid-May, China's exports to the U.S. still plunged by 34.5%, the steepest decline in 5 years. Imports from the U.S. will drop by 18.1%, drastically shrinking the trade surplus with the U.S. to $18 billion, a year-on-year decline of 41.5%. This underscores how severely bilateral tensions are impacting trade flows. In the wake of the tariff cuts, Chinese exporters scrambled to find new markets. Official data shows that exports to Eastern Europe, the European Union, and Africa increased in May. However, these gains could not fully offset the sharp drop in U.S.-bound shipments. Exports to many Western nations have clearly declined. Xu Tiancheng pointed out that overall exports to the West were essentially flat. China's exports of smartphones and household appliances have also been declining, with only cars and ships seeing continued growth in May. Cars up 22% year-on-year and ships up around 5%. On the BN, imports reached 13.92 million tons in May, up 36.2% year-on-year. However, key commodities like oil, coal, and iron ore saw clear drops, signaling that domestic demand remains weak amid rising external pressure. China's domestic economy remained largely sluggish in May. According to China's National Bureau of Statistics on June 9, the Consumer Price Index fell by 0.1%, marking the 4th consecutive month of deflation and highlighting rising import pressures. Even with 2 public holidays in May, the overall weak domestic demand could not be offset. The Producer Price Index fell by 3.3%, the lowest in nearly 2 years. These low price indicators point to insufficient internal demand and mounting import pressure. In response, Beijing recently launched a series of monetary stimulus measures, including cutting market interest rates and offering 500 billion yuan in low-interest loans to support spending in elderly care and services. Despite these efforts, both the real estate and retail sectors continue to struggle. Employment instability and stagnant new housing prices are also suppressing consumer confidence, deepening China's reliance on exports for economic growth. Even more concerning than international trade figures is how these macroeconomic shifts are seeping into the daily lives of average families. While the May trade surplus appeared to widen, it actually reflects weak domestic demand and accumulating inflation risks. The CPI has now increased for 4 straight months, while the PPI recorded its largest drop in 2 years. This not only signals shrinking corporate profit margins, but also indicates a continued erosion of consumer confidence and purchasing power. Particularly given that the real estate and job markets have yet to recover, many families are opting to lock up their wallets, becoming more conservative with their spending. Signs of this new consumption mindset include low gasoline prices during the May Day holiday and many skipping traditional sticky rice dumplings during the Dragon Boat Festival. Falling prices may seem beneficial to consumers in the short term, more discounts, lower costs, but over time they can lead to reduced business investment, resource misallocation, and ultimately a decline in employment and income, forming a vicious cycle. These structural economic pressures are slowly but steadily infiltrating people's everyday lives. Regarding the trade outlook, Chinese economist Huang Zikun noted that the export plunge in May reflects a steep decline in U.S. orders placed prior to the trade ceasefire. A partial rebound might occur in June as firms rush to ship goods during the 90-day tariff truce. However, he warns that it will be difficult for the U.S. to reduce tariffs further, and increases may even be on the table. If that happens, China's export growth could slow significantly before year's end. Persistent overcapacity could keep China mired in economic difficulties for at least another 2 years. According to the Hong Kong Economic Times, When domestic demand is unstable and market competition intensifies, companies often resort to price cuts to stay competitive. A prime example of this right now is the fiercely competitive auto market in China. Some automakers have recently launched a new round of price wars to maintain or grow their market share. Most notably, BYD announced price cuts of up to 34% on nearly 10 of its all-electric and plug-in hybrid models. This move has reignited concerns about another wave of EV price collapses and further confirms the brutal market competition in China. In addition, job losses and income cuts driven by the tariffs are further weakening consumer purchasing power, forcing both manufacturers and service providers to reduce prices again. Since last year, the Chinese government has introduced a new home appliance subsidy program to stimulate consumption. However, economists caution that such measures have only short-term effects and could negatively impact the sales of other products. According to the International Monetary Fund, China's annual average consumer price index stands at 0, one of the lowest among nearly 200 countries. This will mark the first time since the 2009 global financial crisis that China's economic growth rate hit such a low. A recent Bloomberg survey of 67 economists found that China's supply-side contraction is expected to worsen further. In the face of ongoing supply shortages and economic downturn, ordinary citizens need to manage their personal finances with greater caution. First, it's crucial to understand the risks behind falling prices. For instance, lower costs for cars and appliances might signal declining service quality or an unstable supply chain. Second, people should avoid overconsumption or reckless borrowing, and instead maintain healthy savings habits and emergency funds. For those looking to invest, conservative options such as fixed deposits and high-rated bonds are safer under current conditions, where the value of cash is on the rise. At the same time, it's essential to enhance professional skills. Economic downturns often come with structural unemployment. The more flexible and diversified your skill set, the better your chances of remaining competitive in the job market. In the short term, caution and adaptability will be the most practical strategies for every Chinese household. Please subscribe, share, and turn on the notification bell. Let us stand by the truth in turbulent times and light the way in the darkness.